Good morning. Thank you for joining Mayer Brown's Global Financial Markets Teleconference Series. Today's call is entitled Hot Topics in Anti-Money Laundering 2022. My name is Glen Kopp, and I'm a partner in our New York office and a member of the Litigation and Dispute Resolution and White-Collar Defense and Compliance Practices. I'm a former Assistant United States Attorney in the Southern District of New York, where I served for over 5 years. At Mayer Brown, I represent entities and individuals caught in the crosshairs of government enforcement investigations. My work touches on a number of issues important to our clients, including commodities and securities fraud, foreign corruption, government contracting fraud, corporate compliance, insider trading, and criminal antitrust. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to G, F, M, @mayerbrown.com, and we will respond promptly. This is the same email address on your invitation email. Joining me today are Mayer Brown partners Gina Parlovecchio and Brad Resnikoff. Gina Parlovecchio is a partner in Mayer Brown's New York office and a member of the Global White-Collar Defense and Compliance and Regulatory and Investigations Practices. Previously, Gina was an Assistant United States Attorney in the United States Attorney's Office for the Eastern District of New York, where she served as the chief of the office's International Narcotics and Money Laundering section. At the firm, Gina represents individual and corporate clients in internal and government investigations and white-collar criminal defense, with a particular focus advising on anti-money laundering, securities fraud, bribery, corruption, and healthcare matters. Brad Resnikoff is a partner in Mayer Brown's Financial Services Regulatory and Enforcement Practice. He has extensive knowledge of financial crimes law and regulation, including anti-money laundering, economic sanctions, criminal tax evasion, and anti-bribery and corruption. Brad represents non-U.S. and domestic financial institutions in significant multi-jurisdictional civil, criminal, and regulatory proceedings. He also develops investigation strategy and manages internal investigations to assess allegations of misconduct, manage risk, and advise on legal strategies with regulators, law enforcement, and partner institutions. In addition to his enforcement and investigations work, Brad also counsels clients on financial crimes and regulatory compliance issues. Now, with that brief introduction, we'll begin today's discussion. Now, as I mentioned earlier, today's discussion is going to focus on topics regarding money laundering, or AML. So to start, I'm going to turn to Gina and ask her if she could give us a brief description of how the Biden administration has positioned itself vis-a-vis combating money laundering.
Thanks, Glenn. So since taking over in January of 2021, the Biden administration has signaled a number of ways in which it plans to use anti-money laundering to combat crime and corruption. But I think the way, one of the aspects that frames its various objectives is the Biden administration's comprehensive U.S. strategy on countering corruption, which it issued in December of 2021. And that strategy is actually the first of its kind, and it lays out numerous pillars or tools that it plans to implement to fight corruption. Now, one of the principal pillars that the strategy identified is combating illicit finance, which I'll refer to as the follow the money strategy. And it intends to use anti-money laundering rules, regulations, and enforcement to root out corruption and kleptocracy. And it plans to do that in three principal ways. One is improving transparency in financial transactions. Two is increasing obligations of gatekeepers to the financial system. And three is strengthening international collaboration in anti-money laundering investigations and granting new powers to law enforcement that will act as a force multiplier for anti-money laundering enforcement efforts at home and abroad. Now, really, these three different aspects build on recent legislation and actions taken by FinCEN over the last couple of years. And the reason why this is important is it's cause for concern for our financial institution clients and others because it really creates secondary liability for those who may be doing business with kleptocrats or actors who are paying bribes. So it's something to keep an eye on.
Thanks, Gina. One of the things you mentioned is reporting obligations for gatekeepers. Could you address that in the context of AML?
Sure. So one of the things I think Brad is going to talk about today is the Biden administration has signaled that it intends to ramp up reporting requirements to prevent real estate transactions, which has historically been a favored vehicle for money laundering, and to ramp up reporting requirements for professionals in that space. But the administration also will seek to increase reporting obligations of a broad array of gatekeepers beyond real estate professionals to the financial system. So, for example, lawyers, accountants, trust and company service providers. It's anticipated that all of them will have increased reporting requirements. And this is important because historically law enforcement has had difficulty holding these gatekeepers accountable for facilitating transactions that mask illicit funds because the regulations didn't really require gatekeepers to have an understanding of the nature and source of their clients' funds. And the strategy really focuses on changing that. For example, the strategy indicates that the Treasury Department will re-examine anti-money laundering requirements for investment advisors, such as hedge funds and private equity funds. Now, what does that portend? We don't know yet. Still waiting to see what the administration will do, but that is definitely something they've signaled will change. Now, the question is, how will the Biden administration hold gatekeepers accountable? Because, of course, if there's no teeth, then people aren't going to comply. But the administration has signaled that it will be partnering with state licensing authorities to really hit professionals where it hurts if they're not complying with these coming regulations.
Thank you, Gina. And speaking of sort of hitting where it hurts, government needs tools to be able to conduct their investigations. And in the money laundering space, it looks like the government's been sort of rolling out some new tools to conduct these investigations in the money laundering arena. Can you give us a sense, Gina, of what are these sort of new enforcement tools and some of the other efforts that law enforcement's taken?
Sure. So another prominent feature of the strategy in its follow the money component is increased coordination between the U.S. and its partner countries, which portends an increase in cross-border anti-money laundering enforcement. And a lot of that is accomplished through new tools that were established under the Anti-Money Laundering Act that was passed as part of the National Defense Authorization Act of 2021. So some of the key aspects of that include allowing greater sharing of suspicious activity reports with foreign partners, which allows for foreign partners to build up their investigations cross-border in coordination with U.S. law enforcement, sending envoys to work with foreign partners to strengthen their anti-money laundering regime. So, for instance, the Treasury Department and FinCEN sending individuals to partner countries to help them re-examine their anti-money laundering structure and help them investigate anti-money laundering crimes. And I think one of the most important aspects of it is increasing federal prosecutors' subpoena power, which we'll address, which allows federal prosecutors to obtain information from foreign banks about any foreign bank account, so long as that foreign bank has a correspondent account in the United States. Some other features include empowering the DOJ and the Treasury Department to seek forfeiture and recovery of stolen assets, meaning funds traceable to foreign government corruption that are held at U.S. financial institutions and found in the U.S. or in the possession of U.S. persons, and that is accomplished through two different programs that have been highlighted as part of the strategy. And these programs will become all the more important with DOJ's recent announcement about Klepto Capture Task Force, which is an interagency task force aimed at restraining the finances of Russian oligarchs in a variety of ways that will most certainly involve anti-money laundering enforcement.
So, Gina, it sounds like there's some limits on what 6308 subpoena recipients can do in terms of combating their requirement to respond, but are they precluded in total from pushing back or trying to quash such subpoenas?
No, some of the usual defenses still could be asserted. Oftentimes, banks will fall back on a lack of personal jurisdiction in defense of a subpoena. Section 6308 requires non-U.S. banks to appoint an agent authorized to accept service for any account records that may be subpoenaed pursuant to the new law. So there's a question as to how that will play out in the courts. And so, it may be an issue where it's going to be a combination of defenses that may be successful. One other thing to keep in mind, too, is although the legislation does not require an application through the Mutual Legal Assistance Treaty process, there is some process that DOJ must go through for internal approvals. And so there's always the question of reaching out to the government to have a conversation about whether those protocols have been met. But in the end, I think one of the practical takeaways here is that everyone has become aware of this new subpoena power and are aware of it. And so you should be looking out for a subpoena that may look very similar to a Bank of Nova Scotia subpoena. And then you should reach out to someone for guidance on how to approach this going forward with the government.
Thank you, Gina. And now I want to turn to Brad. And Brad, if you could, we've talked about some of the steps that the government has taken in its expansive efforts to combat money laundering. But if you want to, could you give us an update on some other recent legislation regarding those reporting requirements that Gina had mentioned earlier?
Sure, and thanks, Glenn. One of the recent AML regulatory developments of significance in this space is FinCEN's recent proposal to implement the beneficial ownership registration and reporting requirements of the Corporate Transparency Act. Again, this was another legislative effort that was part of the National Defense Authorization Act 2020 that was passed in January 2021. And this new federal requirement is the first of its kind. Whereas financial institutions have had obligations to collect beneficial ownership information from certain legal entity customers since FinCEN issued its Customer Due Diligence Rule, the CDD rule, in 2016, the Corporate Transparency Act and this proposed regulation create new legal obligations for a broad array of U.S. and non-U.S. legal entities. The purpose of the rule is to create a centralized, comprehensive database of beneficial ownership information to assist law enforcement in its efforts to impede bad actors from abusing legal entities, like shell companies, to conceal proceeds of corrupt and criminal acts.
Brad, what are the sort of general requirements of this new rule?
The proposed rule requires U.S. entities, including corporations and LLCs, as well as non-U.S. entities registered to do business in the United States, to register with FinCEN and disclose to FinCEN the identity of ultimate beneficial owners, individuals, defined broadly to include all individuals exercising substantial control over the entity or individuals with a 25% ownership interest. A database containing this information will be housed by FinCEN and made available to law enforcement. Financial institutions may access information in the database reported by their legal entity customers, provided they obtain authorization from their customers to have such access.
And is there any penalties for failing to comply?
Indeed, there are. Willful failure to register and disclose beneficial owner information carries both civil and criminal penalties.
And Brad, are there any exemptions to this rule?
Yeah, Glenn, frankly, this rule is all about the exemptions. There's 23 types of entities exempted from the registration and disclosure requirements of the rule, and because it was drafted so broadly on its face, that's something of a necessity. And some of these exemptions are quite straightforward, such as the exemptions for banks, broker-dealers, SEC reporting issuers, and other entities that are already subject to comprehensive regulatory oversight. And there are other notable exemptions that may have a broad application but are less straightforward. For example, there exists an exemption for pooled investment vehicles, which may apply to special purpose vehicles created for structured finance and other purposes. However, the definition in the proposed rule is relatively narrow, especially when compared with the definition of pooled investment vehicles in the CDD rule, the existing CDD rule. So this new proposal would only cover certain vehicles that are SEC registered investment companies or 3C1 or 3C7 companies. This could prove problematic, frankly, for unregistered investment companies that rely on another exclusion, such as 3C5 companies. This could also prove to be onerous because pooled investment vehicles could be exempt from the CDD rule requirements on the one hand, but subject to the new registration and disclosure requirements of the proposed rule. It's worth noting, however, that FinCEN is expected to issue a new rulemaking in the near term to harmonize the existing CDD rule with the new requirements of the CTA and this proposed implementing regulation. Just briefly, other exemptions that may have broad application and that we think are worth considering are those for large operating companies and subsidiaries of certain specified exempt entities.
Brad, any other considerations for this rule in terms of registration and what folks should consider?
Sure. Whether an entity qualifies for an exemption is a determination that must be made by each entity. You're not, going to get a blessing from FinCEN on this. You've got to figure it out yourself. So your entities subject to the rule, and that's going to be most of them, at least at first blush, need to perform their own analysis. And in the transactional context, banks and their counterparties may want to diligence those exemption determinations in the absence of verification by FinCEN. If a legal entity does not meet one of the exemptions, it has to register and it has to report. And similar to the rule's coverage of a broad group of legal entities, the definitions of ownership, interest, and substantial control will require the identification and reporting of a large number of individuals, including senior executives, as well as beneficial owners, as beneficial owners under the rule.
And Brad, how can a firm like Mayer Brown help clients in this space?
Well, because the rule on its face applies to a huge number of legal entities, I think helping our clients understand whether they qualify for one of the exemptions will be significant. And although the rule is not yet final, FinCEN, for the most part, adopted key definitions almost verbatim from the statute. So I think that we can expect the final rule to look very similar to the proposal. And it's not too early to get started, at least to begin thinking about whether, as a legal entity potentially subject to the rule, you can take advantage of one of the many exemptions. And for banks and other financial institutions that anticipate making requests of their legal entity customers to gain access to the beneficial ownership information maintained in the FinCEN database, you may want to start thinking now about whether or how to update your customer agreements and related documentation to provide for such consent. And finally, it's also worth noting that in the transactional space, we've already seen parties seeking reps and warranties regarding compliance with the CTA. So this is already something that many folks are already looking at in the deal context as well.
Thanks, Brad. Let's stick with you for a moment, and we want to talk about the new proposed reporting requirements for all non-financed real estate transactions. First off, what's covered by these proposed reporting requirements?
Yeah, so Gina mentioned it. In December 2021, FinCEN issued an advance notice of public rulemaking to solicit comments on how it should impose certain record-keeping and reporting requirements on certain persons, a broad group of real estate market participants involved in non-finance real estate transactions. The proposal sets out several different requirements that FinCEN is considering in the alternative. Many of us are already familiar with FinCEN's use of GTOs, geographic targeting orders, which require U.S. title insurance companies to identify the natural persons behind U.S. and non-U.S. legal entities used in certain all-cash purchases of residential real estate, and to report these persons and purchases to FinCEN. But these orders are limited in scope. They've targeted only certain geographic locations, only residential real estate, and create legal obligations only for title insurers. According to FinCEN, in its preamble to this proposed rule, over the course of the last 5 years or so, 30% of the transactions reported under these GTOs involve a beneficial owner that has been the subject of a suspicious activity report filed by a financial institution. I mean, that's just a staggering number. And I think from FinCEN's perspective, it suggests continued money laundering vulnerabilities in the U.S. real estate market. So, frankly, this new proposal would represent something of a sea change for the industry with respect to AML compliance. If adopted, as proposed, the rule would impose on a large number of real estate market participants who have never before had any AML compliance obligations, record-keeping and reporting obligations with respect to a large number of transactions, not just cash transactions in a few specific jurisdictions, but any non-finance purchase of residential or commercial real estate, regardless of value. Now, FinCEN recognizes that not all real estate transactions involve the same types of participants. And so it's crafted a rule that captures several categories of participants, such as real estate developers, managers, real estate lenders, real estate investment companies, and as Gina mentioned, other gatekeepers like lawyers and accountants in this industry. And although the proposal contemplates reporting of all non-finance purchases of real estate, regardless of value, FinCEN is, however, considering the application of a monetary threshold to the rule and has solicited comment on what an appropriate threshold might look like. Also up for consideration is not just record keeping and reporting of non-finance transactions, but also the adoption by many previously unregulated firms of a comprehensive BSA AML compliance program that would include suspicious activity monitoring and reporting, among other things.
Now, Brad, where do things stand on the adoption of these reporting requirements in the real estate space?
Yeah, Glenn, unlike the beneficial ownership proposal that we discussed previously, this ANPR, the way it's been written suggests that, FinCEN is going to take some time to craft a rule that makes sense for the industry and its participants, which of course is a good thing. Because the proposal at present is considering various alternative requirements and different thresholds, it seems likely that a final rule is still a ways off.
And so, Brad, what are some of your key takeaways on this proposed new rule?
We'll see where the proposal winds up in the coming months, but I think the big takeaway here is that there are going to be a potentially large number of real estate market participants facing significant AML compliance obligations for the first time. As we discussed in the context of the beneficial ownership reporting rule, this real estate-related proposal is another example of FinCEN casting a wider net than they have before in terms of the type of persons subject to its regulations.
And what can market participants who are most likely to be covered by the proposed regulations start doing, right now?
So the comment period for the ANPR has now closed, but I would expect additional notice and comment to occur, given that FinCEN has sought comment on these various alternative requirements. I mean, we're not really close to a final rule yet, and so there's a lot more for FinCEN to do to get this rule into shape. And so during the next notice and comment period, we would urge those affected by the proposal to engage FinCEN to help shape it in a way that makes sense for everybody. And if you're a title insurer or other market participant potentially covered by the rule, you might begin to consider how you would implement record keeping and reporting obligations with respect to non-finance transactions, or even a more comprehensive AML compliance program if that's the direction FinCEN ultimately pursues. And I think, to begin, having strong record-keeping policies and procedures and a strong compliance culture would help with the transition to whatever approach FinCEN ultimately adopts.
Thanks, Brad. I think we're going to shift focus a little bit here and move to a topic that's really getting everyone's attention these days, which are digital assets. And Gina, I want to turn to you, and if you could you give us a sense of why is it that digital assets present a unique concern from a money laundering perspective?
So one of the reasons is because of the pseudonymous nature of digital assets. I think there's a misconception that digital assets present total anonymity. That's not quite right, but there is a pseudonymous element to it that allows wrongdoers to exploit digital assets for money laundering purposes. So early on in their adoption, digital assets received a lot of attention from law enforcement because of that aspect of it. And so a lot of attention has been focused on regulation to prevent digital assets from being exploited for money laundering, and also law enforcement has been focusing on digital assets for more enforcement activities. So one of the ways we saw that play out was in October of this past year when the DOJ established the NCET, the National Cryptocurrency Enforcement Task Force, which is comprised of not only the Department of Justice prosecutors, but also numerous agencies, including the IRS, FBI, and DEA, among others. So we can anticipate seeing a lot more enforcement activity in that space. But in addition to the DOJ's NCET task force, we've also seen some enforcement activity coming from other regulators, such as the CFTC, SEC, and of course, FinCEN has been active in issuing guidance about who needs to be registering when engaging in financial transactions with digital assets. And there have been several of these enforcement actions coming out of DOJ have been based on actors' failure to register with FinCEN as unlicensed money remitters. So that is something to keep an eye on because FinCEN is very active in setting out guidelines in this space.
Now, Brad, what are you hearing about how regulators might approach the digital asset space?
The pace of change in the digital assets market is incredibly fast. I think we all recognize that, and I think to date, the agencies have struggled to keep up, frankly. But I think they also recognize that, and they're collaborating with one another. And there's several different proposals on the table from the banking agencies, in particular. The Fed, for example, is considering issuing a stable coin that would be a liability of the central bank and made widely available to the general public. They published a paper on it recently. The FDIC views digital assets more broadly as presenting potential safety and soundness concerns to banks that have begun to enter the market. And of course, now we're seeing, what started out as, these small fintechs. We're now seeing major players in the digital assets market. The OCC has been active chartering banks with, fintechy activities, for lack of a better word, and based on remarks made by Benjamin McDonough, the general counsel of the OCC, at the recent conference of the Institute of International Bankers. This is ongoing. This is, they're happy with this. They're going to continue doing this. And I think, OCC is in favor of bringing digital assets into its regulatory perimeter. And I think the fact that digital assets have been used in connection with criminal schemes is I think, from a regulatory perspective, all the more reason to carefully integrate and regulate this new asset class in a comprehensive way. And so I think the banking agencies, SEC, CFTC, and FinCEN are all collaborating in this respect. It's also worth noting that the New York DFS has also been very active in chartering fintechs in the digital asset space. I think from an AML perspective, risk-based principles still apply. And if you're a fintech or a bank active in the digital assets market, to the extent you haven't already done so, to the extent you're a new participant in the market, you need to start thinking about a risk assessment of the digital asset products and services you're offering and integrating those products and services into your already existing BSA compliance program.
Thank you, Brad, and thank you to our audience for tuning in. A few brief reminders. You'll receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Lastly, as I mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may now all disconnect.